is if the stock market takes another leg down, and this time with desperation and fear on the part of investors, and you get data point related consequences, the central banks will have to change policy whether they want to admit it or not, because they'll be in a desperate situation to defend key assets. Gold will be the beneficiary, again, of monetary softening, and it knows what's coming. I think that's why it's so steady.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for March 7th through March 14th, 2023, while supplies last. This week we feature two 4/9 fine silver coins, 2022 Silver Maples at $3.40 over spot, and the 2023 Silver Kangaroo at just $3.39 over spot. Silver Maples were the first silver sovereign coins to be minted at 4/9 fine purity and remain one of the most in-demand coins today. They come 25 to a tube, 500 to a box, and are available at the lowest premium we've seen in more than a year, at just $3.40 over spot. The 2023 Silver Kangaroo from Australia also offers 4/9 fine purity and comes 25 to a tube. However, the Australian Monster Box is just 250 coins, making it the most affordable Monster Box available, especially with a premium of just $3.39 over spot per ounce. Both coins this week are also IRA eligible. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order these specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Michael Oliver from Momentum Structural Analysis, olivermsa.com. Michael, thank you so much for joining us today.
Good to be back.
Well, it's great to have you, especially in this exciting time in the metals markets. What is your perspective on what we're seeing in the metals markets? I know your latest piece on silver, you're still extremely bullish on silver despite the pullback.
Well, after their surge in mid-2020, gold and silver got up to 30. Actually, it made its high in early 2021 for silver, made a new high in January of 2021, just above 30. But after that point, gold and silver entered a corrective process where it was sort of a net decline, but it was full of sharp rallies, zigzags, counter trend rallies, you could call it, all during that corrective process. Silver suffered more in the correction than did gold percent-wise. And that's usually the case with silver, that in uptrends, it'll outpace gold, and downtrends, it'll outpace gold on the downside. So that was the case here. But that low we made last summer, especially on gold, did something. There were a lot of price chart watchers who were looking simply at price charts. And they went back and they saw the 2011 high. That's when gold was $1,920 at a peak, okay? Then in late 2011 through 12, it entered a congestion zone or a trading range, generally with slightly lower highs, but it's sort of flat across the top. But, it was under pressure. We were bearish at that point. We turned bearish in January of 2012 based on long-term momentum. So we thought it was the topping process. And in fact, in spring of 2013, you finally broke through this floor that gold had built on a price chart. And boy, you paid for it. You went from mid-1500s down into the 1100s and ultimately 1050, okay, over the next year or so. When you looked at the price chart of the current gold market, going back, let's say, to the 2015 bear low, which is 1050, and you look at the advance, and when we got up into the summer of 2020, which, by the way, was only a doubling in the price of gold, whereas that 2011 peak was an eightfold in gold that had been underway since the year 2000. So very much older than the current thing. But gold on the price charts recently, up through last summer, looked exactly like the 2011 peak. And a lot of people were enamored of that, said, oh, gold's going to collapse, big bear market coming. Well, you went down and you blew out the flat lows that had occurred in gold over the prior couple of years, late 2020, 21, summer 2021. Price of gold get down in the 1670s and shoot back up again. So it made a floor. It was very obvious. When you broke that floor, it looked just like you did in the spring of 2012 when gold started to crash. We didn't think this time, after breaking that obvious price floor, that it was valid. We thought it was an invalid price breakout that would not sustain. And we called it a bear trap. And in fact, it was. You went down to 16.13, I think was the price low. So you dropped another 3% below the floor. Price people were just screaming, oh, this is just like 2011 top, we're going to the big bear market and all this stuff. We aborted back up into that range late last year, got back up to 1700. And at that point, we turned bullish again based on momentum factors for gold. Well, gold shot from 1700 up to mid 1900s, back up near the top end of the range. We think that breakout that you had to the downside last summer, the trap, was in fact the exhaustion of the selling process. And so, yes, you're getting a sell-off now from the January peak, which we had at about 1950. You pull back to 1820 area right now. And we think this sell-off is counter trend, meaning counter to the new emergent uptrend. So we think, yes, you're getting a sell-off now, but it's just like what was going on from 2020 through 2020, late 2022. The rallies were failing. And you were making lower lows in silver and gold. This time we think the tables have turned. And yes, while you're getting a sell-off, this sell-off is counter to the new trend back to the upside. So we don't think this sell-off is going to lead to some precipitous further decline. We think that was attempted last summer in gold, and it failed. The bears failed. And we think now the process has shifted. Now, to turn on the price guys, to make them realize that, hey, this really, it's back to positive, you're probably going to have to go up through the highs, get back to 2,000 plus and blow it through the highs. And then they'll say, well, I guess we were wrong, But we're arguing that's the likely outcome. That we think the current pullback will not go down and blow out the summer lows. We think that was exhaustive. And it's true, we think, with silver as well. It made a low near $17. Right now we're trading 20.25, I think. And I think this pullback is counter trend for silver. Now, we issued some charts in a special report the other day that sort of explain why we have that assumption. So we show the price chart, but we also show a couple long-term momentum charts. And when you look at those momentum charts, you'll see a different picture than when you see the price chart. Case of the price chart, you have this parallel gradual downtrend channel that's been in existence since early 2021 on silver. But there's a lot of sharp rallies within this gradually declining tube. And the recent rally went up near the top of that channel on price, so it didn't break out. We got up to 2470 something was the high recently. When momentum in that rally in December and January of this year, when we got up to the 24 plus level, momentum broke out big time, very clearly. So it did something that price didn't do. And quite often that's what happens when market shifts a trend. The first indicator to shift trend, obviously, will be the momentum factors, and secondarily be price. So it's the next upturn in silver. You get back up to 24 plus again, the price people are going to wake up. And we think this pullback is counter trend. So that's our current assessment, and we have done every reason to doubt it.
And it is really interesting when you look at that momentum chart we can share on the screen here. It definitely, there's a clear breakout from the downward trend there. And even though we've seen this pullback, we're still not below that downward trend there. We're still above that.
Right. Yeah. And the pullback, when you look at the momentum chart, if that chart were a price chart, you say, hey, I think I want to be a buyer here, because you're pulling back to what looks like an area of support on the momentum chart. And this is why we emphasize our use of momentum as a tool, because usually it's a step ahead of price. It usually will top before price becomes obvious. It'll bottom before price becomes obvious. And I think that's the case that since the last summer's low in both of those metals, they've now shifted to positive momentum trend. Therefore, this pullback is a pullback, not a resumption of the downtrend. That's our assessment.
Now, when it comes to commodities and also oil, I know that you're bullish on both of those, and it seems like there could be a breakout to the upside for general commodities and also oil. This seems like it could impact inflation going forward. Can you give your perspectives on those markets and also how it may impact inflation?
We think a lot of the big pieces of this puzzle that are sort of floating around, the stock, the bond market, commodities and gold. Gold is not necessarily attached to commodities, by the way. Gold doubled in price while commodities stayed in the sewer. Okay, between 2015 and 2020, gold doubled and commodities were still at their low. The pullback we've had in commodities, by the way, which began shortly after the Russia-Ukraine conflict started, which is February of 2022. If you look at the commodity index, Bloomberg Commodity Index, or price of oil, or many commodities, you'll see they peaked then, soon thereafter, a week or two later. And since then, for over a year, most commodities have been in a downward process, not the kind of process that erased the gains that we saw. We put out a buy signal in October 2020. At that point, Bloomberg Commodity Index was 70. It doubled and went to 140 by early 2022. Most of that prior to the Ukraine event. Okay, so that wasn't the reason. And then we've had a year-long pullback in the Bloomberg, such it's trading right now around 105. So it's not back to its 70 price lows of 2020. It's pulled back, and it's been really an arduous pullback, meaning overlapping. It's not been a collapse. It's been an arm wrestling event. And it looks to us, and we haven't signaled it yet, both oil and Bloomberg Commodity Index have some numbers just above them. In fact, oil went up to the numbers this week and then failed at it. Just above 80 in oil. I want to close a week out up in there. And the Bloomberg up around 109. Right now it's trading 105.5. I think the high this week was something like 108. So just above the current market, both on the Bloomberg Commodity Index, the broad metric, and crude oil, they both have some trigger levels that tell us that this corrective process that we've been undergoing for over a year is over, and they're resuming an uptrend, the longer-term uptrend. Well, now, think about that for a minute. Your assumption right now, if you're a stock investor, is that, oh my gosh, if commodities start back up again, if the price of gasoline goes back up again, the nightly news about how it's pulled back, and oh my gosh, the Fed's going to keep the, QT tightening going. They're not going to shift their policy. They're not going to soften. They're going to be ambushed by commodity resurgence again. Okay, interesting assumption. That's one big piece of the puzzle, because that should be bearish for bonds, meaning we're going to get higher yields, bond prices go down, and stocks go down. So it's a nightmare for them to think commodities will go up. But in fact, I think what's about to happen, our assessment is this, that the joining at the hip of bonds and stocks over the last year or so, where they both gone down sharply together. Bonds, for example, last year were down like 30 some odd % in price. Look at TLT, for example, popular long-term bond ETF. It was down, I think, 33% from 21's close to 22's close. S&P was down 20% last year. And that was a rally late in the year. NASDAQ 100, the leadership index, was down 30-something %. Huge losses on both sides of that so-called balanced portfolio, 60% stocks, 40% bonds. So anybody in the normal portfolio got massacred last year. We think, though, that when we examine the T-bond market, we think that it may have made its low, or if it makes a new low, meaning one more rise in yields on the long end, we're talking 20-year on out, it'll only be marginal. We think the T-bond market is actually, if you look at a price chart of TLT, it's back down to the 2009 levels where it was then during the crisis. Okay. So if the stock market had matched what bonds did over the last year and a half or so, the S&P be trading about 1,500. Okay. So the stock market is not nearly matched what the bonds have done. We think the bond market bear is essentially about over, and we think it's probably entering a basing period. Why would bonds start to level off in price and maybe drop in yields, let's say later this year? If you had a commodity upturn again, and the Fed were under, therefore, policy pressure not to loosen. And, of course, that would hurt the stock market, but the bond market's already taken its punishment in our view. We think it's basically done, so that the linkage between bonds and stocks, which hurt people last year, will not hurt them this year. This year, I think, by the end of 2023, you'll probably make money in bonds and lose a lot in stocks. So that's those two big pieces of the puzzle, I think, are about to separate. Most people, I don't think, are anticipating that. Why would bonds stabilize and go up if, in fact, commodities have another leg up? because it doesn't make sense when you think it's a Fed-only issue because the stock market takes a dive. When we called the top in the stock market, it was January of 2022 in the NASDAQ and February of 2022 for the S&P. They were just off their highs, which occurred in late 2021. We said that the first leg down would be an arm wrestling match, not a crash. And sure enough, if you look at a price chart of S&P or NASDAQ, while net on balance, it was a pretty big drop for the year. It was an arm wrestling decline, overlapping rallies and so forth. So it teased you all along to the point now where people are using the word bottom again. It's bottoming. We're going to have a soft landing, all this kind of stuff. What will shock people is if, and we think the technicals will bear this out, that the stock market, in fact, rolls over again to the point where, and it's not far below current levels, we think it will be triggered, where then the investor who's full of hope now that this was merely a fake out sell-off and the stock market's going to resume its big bull trend, they're going to be disappointed. And once that disappointment hits that market and the doubt about whether it's in the downtrend or not suddenly shifts back to, yes, it's really in the downtrend, that's when you get a more massive liquidation of assets out of that sector. And also you'll probably get data points, economic data points that have not indicated negative will suddenly at that point lagged to the market will join in. That's the way it usually happens, by the way. Usually the data points don't lead the market leads the data points. At that point, the central banks of the Western world, including Japan, let's say, and the ECB, and of course the Fed, will have to seriously consider that regardless of a recovery in commodities, that debt markets, corporate high yield corporate debt, which got hammered last year, muni bonds, treasuries need to be supported because revenues to the IRS may be less this year because nobody had capital gains last year, 2022 anyway. So suddenly the Fed's going to be facing a different set of fundamentals. Yes, they're going to have commodity resurgence, but they're going to have weakness in the stock market and economic factors that counterbalances that to where they have to move in back to what central banks traditionally, what they were made to do, and that's support the government debt markets and support the paper markets that government deems to be important, like the stock market. So the three big tectonic plates that are floating around right now, I think the commodity one has people fooled. They think it's in correction, the Fed's winning. If that shifts, that's going to shock people. A break in the stock market, not a handful of percentage points below where you are now, we think it gets triggered back to the downside. And the bonds making a bottom. There's going to be a lot of asset reallocation that goes on. Now, step back a minute and you're thinking about gold and silver again, which we favor. Admittedly, when you look at gold, since the close of 2021, the close of 2022, through now March of 2023, where is it trading? Either side of 1820. It's where we are right now. It closed 2021 there, it closed 2022 there, and here we are into 2023, and it's still trading either side of 1820, which tells you what? Why didn't that asset collapse when the Fed said we're going to raise rates and stop inflation? All they'd stopped is they broke their stock market bubble. They collapsed their government bond market and other related paper assets. But commodities went up and gold held its own. In fact, silver had a net up year, a couple percent last year versus where it was in 2021. Wild child that it is. But that says something. If you're an asset manager and you're managing hundreds of millions of dollars or billions even, and you're looking at the movement of these asset categories, any one of which you could shift more into or less out of and so forth, you're noticing, whether you like it or not, that gold is not losing money from an investment point of view. It's gone sideways. Yes, it's oscillated, teased people both ways, but it has not gone down when the rest of the world went down. Why? Perhaps because gold anticipates what's ultimately the outcome here. And that is, if the stock market takes another leg down, and this time with desperation and fear on the part of investors, and you get data point related consequences, the central banks will have to change policy whether they want to admit it or not, because they'll be in a desperate situation to defend key assets. Gold will be the beneficiary again, of monetary softening. And it knows what's coming. I think that's why it's so steady.
It does seem like an exciting time forward when we look at bonds and stocks disconnecting and bonds rallying again. It seems like that may put pressure on metals, but can you kind of explain why you're still then bullish on metals, and do you think they'll outperform bonds going forward?
Oh, yes. I think if bonds uptick, they'll uptick a little. And when I say they'll make a low, they may make a new price low first. The low we made in October, we had pinned down. Before it got to that low, we had defined a level where we thought the bonds would bounce. And they went like a point below where we said they'd go, and then they bounced sharply into December and January. And they're still above that low. Now, it may be that in the process of this basing, which we think the bonds will undergo over the next, let's say, quarter, that the advance you get will be noticeable, but it's not going to match gold. Now, in the past, by the way, there have been times where bonds move with gold. Okay. And we don't think a bond movement right now back to the upside or a drop in yields is so much because of the Fed. It's because investors perceive the equity category to be such a high risk area. They give up on it, which they haven't done yet. If they give up on the equity category, if it starts back down again and they say, oh my gosh, it wasn't a bottom. Okay. Where do they move their money? Well, they're getting 3.6% yield on 10-year bonds, I think, and they're getting 4% on 5-year bonds. And they've had the price beat out of them. They're down at 2009 price levels. It'd be like S&P at 1,500. It's paid its dues, okay? S&P hasn't. NASDAQ hasn't. So I think there could be a divorce simply on value, a sense of safety, buying the bonds, getting a decent yield, and sort of not having to worry about that stock market anymore. So we think the money could move back into bonds. Not that it's going to be a dynamic bull, but simply stabilize. And I think during that time, if the stock market does in fact weaken and go into its next leg, which is the one that will have fear attached to it and depth, that's when the asset managers and large investors suddenly perceive that, oh, what category hasn't been behaving badly despite some volatility? Net on balance, it's been hanging in there, and they're going to see gold. And ultimately, I think they're going to see gold miners and silver, where silver and the gold miners will again outpace gold. This is typical in bull markets in gold. There's points in that bull market where gold gets outpaced vastly by the mining category and by silver. And I think this next phase up in gold, coming out of this congestion zone, we burst through the 2000 level again. It's that point in time where you're definitely going to see silver and miners outpace gold on a percentage basis. And I think part of the reason for that will simply be very large asset managers plowing money into blue chip gold stocks primarily. At least that'll be where they start. Small investors will then crowd into the smaller stuff. But I think at that point, that's when you get more emotion that impacts this very small category, the mining category. It's a tiny little sector. And if money perceives it to be, yes, it's been up and down, but it's still, if you look at a spread chart, in fact, of gold miners, GDX, let's say, and measure it versus the S&P, you won't believe this, but you're actually higher in GDX than you were back in 2016 when it was measured against the S&P, and especially the XAU index. So in other words, they've actually been behaving fairly well relative to the lows they made when gold made its bear low. I think GDX made a low at about 14 or something. It's trading where? 28. So it's doing, when you look back 5 or 6 years, it's still up there, even though it's down recently. But anyway, I think it's the next leg down in the stock market that precipitates thought processes on asset managers who know these numbers. I mean, they see these charts. What did gold do last year? Nothing. Oh, wow. I wish I'd done nothing, and they start to move more and more money into that category and related stocks. And I think that will occur, especially when the stock market starts its next leg down.
All right. Well, it'll be very interesting, Michael, to continue to track this with you. Any last thoughts before we let you go? And where can our viewers find you online?
Well, go to the website, olivermsa.com, and there's a little tab at the top that says About. You can click on that or Contact. And I have my email address below my picture. Click on it and request some sample reports. We've got some important reports coming out this week. We put one out on silver the other day. We'll one on gold, I think, today, and this weekend report. And you can see what we think and how we think, and be happy to send it to you.
Fantastic. Well, Michael, once again, thank you so much for your time, and God bless.
Thank you, Elijah.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.